Well, good morning and welcome to the December 2024 update for the Spears & Associates Drilling and Production Outlook. I'm John Spears.
And I'm Richard Spears. Just like the old days 2 years ago when we used to do a podcast.
That's right. We'll be here for the next 60 minutes talking about how we see activity in unfolding in 2025 and for years beyond here in the U.S. and Canada and around the world. Richard will be with us for a few more minutes, and then joining us for the Q&A at the back end of the thing.
I'm like, for the people who are American football fans, I'm John Madden.
There you go.
I'm the Keller commentator.
So, Richard, you were speaking to an industry group yesterday, and just to sort of set up the crowd here today, what was the top of mind topic for the folks you were talking to? Who were they, and what was their concern?
It's one of my favorite events every year. In early December of each year, the joint meeting of the Society of Petroleum Engineers Drilling Study Group, and then the AADE, American Association of Drilling Engineers, have a joint meeting. It's at the Petroleum Club in Houston. It always sells out. So 180 people yesterday to hear me talk about your forecast. It's apparently you should go. We just short circuit everything. But even though it was wide ranging and we covered exploration all the way to production management, it was drilling focused, and if you could identify a single question, it was, what is the impact domestically and internationally of the incoming brand spanking new American president? Is it a good thing? Is it a bad thing? And and the way I did it was I showed 25 years of history plus next year.
There you
go. And Keller coded it to Republican presidents and Democratic presidents to show the impact of it. So anyway, you're going to be talking about that.
Yeah, very good. Okay, well,
I'll give the punchline at the end of our talk.
Okay.
At the end of your presentation.
Okay, that sounds good. Well, I think we've spent enough time.
Well, except how are people going to ask you questions?
Well, see, that's what I was about to say. So we want to use the session to sort through the headlines, talk about the factors driving capital decisions in the upstream sector and what that all means for drilling activity. First part of the session, I'm going to go through the slide deck summarizing this current state of affairs. After that, Richard and I and for questions. Those questions can be sent to us via the webinar chat box. I'll try to get these answered some during the course of the session, and then if not, then end when we're doing just strictly Q&A piece. Some I think have already come in, so you can send them to us directly or via our email address at sai@search.com.
This is being recorded.
Yes.
And if you are actually watching this, in January, you can still send a question. We're just not going to send an answer. All right, I'm going to let you do your gig. Right?
Just one final piece of housekeeping. You might sit here. Slide deck and supporting PDF and Excel files have already been sent out to DPO subscribers. Someone from your hasn't received the list. And then finally, feel free to link this webinar on social media, particularly LinkedIn, where it's being broadcast. The details of our forecast or our paying customer discussion that we're having folks there. So with that, out of the way,
I think your parole officer is actually monitoring this. All right.
And
I'll be back in a bit.
Sounds good. We'll switch to the slide deck here in just a second. So yeah, I know that we want to get through this done because I know a lot of folks in our audience are probably most looking forward to the upcoming Hot Stove League for the winter baseball meetings, and wanting to know if Juan Soto can actually sign a $600 million contract this year. So we'll try and get this done and be out of here in an hour's time so that you can get back to the important things about what your favorite baseball players are doing. We'll start with our slides as we usually do, looking at oil and gas demand around the world. And so that's particularly important because given the concerns of Richard's audience yesterday about the incoming administration in Washington, I think it's fair to say that most folks expect that that the new administration will increase the amount of uncertainty in oil markets, particularly because its focus is on trade policy and higher tariffs across the board, not just for oil and gas imports, but on any number of products. And of course, that would set off a response among the nations. And so exactly how that might play out and affect oil markets is of great interest, but at this point, it remains to be seen what that might be. But so the uncertainty level, I think, will go higher. The other bit, it's sort of a secondary factor I think we need to be aware of, is that like Trump won, they restricted Iranian oil exports, and to the tune of about 1 million or 1.5 million barrels a day less than what they stand right now. So I wouldn't be surprised to see that something like that might also be a factor in oil markets come 2025. So there's certainly a potential to have Washington affect oil markets as next year unfolds. But I think at this point, most folks expect that the basic supply-demand fundamentals will really be the main drivers of the market. So what's the outlook for China's oil demand numbers? How much will non-OPEC oil supply grow in 2025? And most importantly, perhaps, how many barrels will OPEC Plus be returning to the market as it would like to do in 2025? So a lot of that kind of stuff going on. A chart on the left-hand side on this slide looks at the change in oil demand over the past 3 years, or 2023, 24, and what we think will be the case in 2025. Again, the point we've made, if you were sitting here 3 months ago when we were talking about this particular deck, was that while the news regarding oil consumption and the outlook for oil consumption is all about the US, Europe, and China, what you see is that 90% of the growth is taking place outside those headline areas. So other Asia, and in the gold part of that left-hand chart is the rest of the world. So a solid 1 million barrel a day growth in 2023, another 1 million barrel a day growth in 2024, and another 1 million barrel a day growth in 2025. So independent of all the angst around China, US, and Europe, I think we can pretty confidently count on 1 million barrel a day growth in oil consumption in 2025 again. And I think it's just that kind of thing as our second and third world brethren, our lesser developed countries, increase their oil consumption. It's very hard to imagine or even forecast a point when oil consumption on a global basis might even peak. I think we're good for 5-10 years at least in terms of further oil growth, which then feeds back into some of the actions that some of the bigger majors have taken in recent months in terms of factoring back their investment in renewables and returning to their roots in terms of focusing on oil and gas production. So demand is on the left-hand side, change in oil supply is on the right-hand side, and again, the part in black is the U.S. So U.S. Production growth has been decelerating for the past couple of years now, and it's projected to continue to decelerate come next year as well. The pinkish part of the bar is Canada. Canada has seen a fairly substantial increase in its output this year and will again next year thanks to new pipelines that are in place. So that's a major element of the growth in non-OPEC oil supply. And then you're getting the usual stuff from Guyana, Brazil, and so forth. The hard part of the bar that is of interest to everybody is the red piece, which is the OPEC Plus story. So OPEC Plus has withheld something over 2 million barrels a day starting a couple of years ago in an attempt to lower inventories, support prices, kind of balance the market. And that oil remains off the market. The intent had been that it would begin to be filtering back in, that it would, the taper would allow some of these barrels to gradually re-enter the market. And that's been a great worry. That's been weighing on the market, I think, in terms of depressing prices. But I think OPEC Plus has been pretty clear in their actions over the last 3 months that they're only going to reintroduce barrels if the market can support them. The demand is there for those barrels at a price that's agreeable. So something probably with around a Brent price of about $80 would be my guess. We've seen Brent prices trade in the mid-70s, low 70s for the last 3 months. And so as a result, OPEC has said, nope, we're going to delay 1 month at a time. We're not going to bring those barrels back to the market. Now they've pushed that reentry point back into 2025. My guess would be that if we're correct on the left-hand side with about 1 million barrels a day or so of growth in oil consumption, that we will see very few new OPEC barrels re-enter the market in 2025, because I think the reentry of those barrels will be entirely market dependent and price sensitive. Now, what does that mean for those of us here in the U.S. with an interest on the production side of things for oil anyway? We're looking at another slight growth from an oil production standpoint. We'll be this year we're around 13.2 million barrels a day, and next year maybe around 13.5 million barrels a day total production. So a 2+% increase this year and next year on the oil side here in the U.S. What's really interesting, I think, is for those of us who look at things on a regional basis, all that incremental growth that we're talking about, both last year, both 2024 and 2025, is really coming from just two areas: the Permian, which is the biggest part of it, and the Bakken is the other piece. So between the two of them, they're accounting for the Permian 75%, the Bakken 25 or 30% of the incremental growth that we see on the oil side. Natural gas liquids production is a function, of course, of gas processing. We process about 80% of the gas we produce. That's about 80% of the gas produced in the U.S. anymore is associated gas in conjunction with oil production. So it needs to be processed for liquids to be removed, contaminants to be removed, and whatnot before it can go into a pipeline and onto the customer. What that has meant is that natural gas liquids production, propane, ethane, and the like, has really skyrocketed over the last few years, and something like 40% of the NGL supply ends up getting exported. So again, on the oil side, we're exporting something on the order of about 30% of our oil production. On the natural gas liquid side, we're exporting about 40% of our production to markets. And so what's really key there then is demand for petrochemicals and refined products, things like that, around the world. So far that's been pretty strong, and it looks like we'll see another slight gain in 2025 on the NGL side. On the gas production side, well, first let's talk about gas demand. So gas demand in the U.S. this year looks like it's going to be up slightly, but the forecast is at this point that consumption will be down 0.5% or thereabouts in 2025. I'm a little that forecast of a decline in production or a decline in gas demand, I should say, for next year is a bit of a head scratcher as far as I'm concerned, because we've seen in a lot of moves in the power sector, which would suggest that demand in that part of the market for gas is rising and poised to continue to rise. So two things. Of course, we've all heard about artificial intelligence, AI, and then data centers. The utilities, power utilities, collectively are forecasting something like a 5% compounded growth rate in the demand for power over the next decade. So whereas before, a year ago, 2 years ago, they were talking about maybe a 1% CAGR in terms of power consumption. Now they're talking about 5%. And the fact of the matter is that the only short-term supply that can really meet that is natural gas, right? Now, on the coal-fired side of things, we're due to retire a number of coal-fired plants this year. I think we're taking about 4 gigawatts of power plant capacity, coal-fired power plant capacity out of the market in 2025. And then there's another 15 to 20 gigawatts, I think, they're due to be retired between 2026 and 2028. So we're seeing a lot of coal-fired plants, scheduled to be retired. Now, with the new administration in Washington, maybe some of those scheduled retirements will be relaxed. But there are those who have run the numbers and suggested just in the power sector alone, we might see over the balance of this decade something on the order of about another 9 billion cubic feet a day demand for gas just in the power sector. Now, we're consuming, let's call it 90 BCF a day across the U.S. as a whole, across all our sectors. So, 9 BCF just coming from power is about a 10% incremental growth between now and 2030. So a pretty substantial increase. And again, it makes me think that any short-term forecast that calls for a downturn in consumption, there's a lot of explaining to do. So we'll see if the U.S. consumption piece is as bearish as what the consensus forecasts are right now. Of course, LNG exports, gas exports by pipeline are forecast to grow something on the order of 10% this coming year. And so in all, we're looking at overall gas demand numbers, the combination of consumption plus exports growing about 1.5%. The one thing I will say about LNG, because I know that there's a lot of interest in that particular market, again, with new administration in Washington, we expect, like others, that the pause on granting permits to new LNG export facilities, that pause will be lifted, and so projects will be allowed to go forward. So based on that, it would appear that our ability to export LNG will basically double between now and 2030. We're at 12 to 14 BCF a day capacity, and now we'll get to around 24 BCF a day with the plants that are being built, plus the ones that probably will get built with the pause being lifted. So roughly double our export capacity at that point. Qatar, the other major producer that has growth plans, expects to more than double, no, just about double its capacity to export LNG between now and 2030. So between the US and Qatar, you have producers which account for about 40% of the market today, expecting to double their export capacity between now and the end of the decade. And I bring that all up because when you look at the demand picture for LNG, there's a lot of questions in my mind. Europe right now accounts for about 30% of LNG demand on a global basis. Europe is about to slip into recession, I believe, and so I would expect that its demand for natural gas, LNG imports, is probably going to be flat to down, not only next year, but I think over the balance of the decade. So you've got 30% of the market that I see very little chance of growth happening in. There's another 10% of the, or so of the market that's LNG import market, that's China. And while China has grown a lot in the past in order to get to 10%, I don't think it's going to grow its LNG imports very much between now and the end of the decade. I think much of the incremental gas that it will need will come by pipeline from Russia. I mean, that's really where the Russians are pushing. I think that'll happen. They're going to sell, Russians will sell their gas at a much lower price than what LNG imports will be, and the Chinese will pivot accordingly. So I see 40% of the market, Europe and China, 40% of the LNG import market, just not growing very much over the next part of the decade. That leaves 60% of the market scattered around the world, which will probably grow, but I'm not sure it's going to grow fast enough to absorb entirely the 40% expansion in capacity to ship LNG. So my guess would be that LNG prices will probably be fairly soft, will soften from where they have been in the recent past. And so while that'll, we'll send more gas out the door via LNG, and our wellhead prices, I think, for natural gas will improve. But I don't think they're going to improve as much as what some folks have been saying. And so we're a little cautious in our estimate for natural gas prices, both next year and over the balance of the decade, and that's the reason why we're just, with 10% or 20% of our gas production being exported and keyed to the LNG market, there's rough spots in LNG that I think we're gonna have to pick through in order to get to the end of the decade, and that's going to be a bit of a problem for folks. But in the meantime, the activity forecast that we've put together is based on these price assumptions. Oil will average this year somewhere around $76 a barrel. We estimate that next year it'll average 70, which is just the midpoint in what we think will be a trading range of between 65 and 75 over the course of the year. And on the gas side, natural gas prices, which have averaged around $2, will end up averaging around $2.07 this year. We hope will be around $2.50, $2.55 come next year. So we think there'll be a recovery Natural gas inventories, which were all out of balance all through 2024, we hope will be in balance if we have normal winter weather and some improvement in consumption. And so that'll allow gas prices to rally. The point I would make is even at a $2.50 price, most operators most gas producers are not in the black at that kind of a price. There might be some in the Marcellus that can make a profit at a $2.50 handle for gas, but most won't be able to. I think most are hoping or need to get to around a $3 price before the average gas producer is in the black with regard to his wellhead gas sales. So a recovery in natural gas prices, we think, even if it's from almost a 25% improvement, still won't get us move the needle to put a lot of rigs back to work drilling gas wells in the gas-prone basins of the Marcellus and of the Haynesville. So that is a part of what we're trying to consider when we think about activity in the coming year, is where's that break-even point for your average gas producer. On the oil side, break-even points are in the $50 range maybe. So we anticipate that oil prices will be safely above that level, but gas is a different story, and even an improvement in gas prices will be slow to be felt in terms of rig count. The other thing that, again, we feel it's important to keep track of is what's the reinvestment ratio among oil producers. So here we've looked at a cohort of publicly traded U.S.-based oil companies, and so most of the dollars that they're spending are here in the U.S. Very few of them go overseas. And what we've calculated is the reinvestment ratio. So we've taken their CapEx and divided it by cash flow from operations. And what you see is a chart that goes back to the first days of 2021. The point I always make when I'm presenting this to an audience is that if I had done the numbers back to 2018, that the reinvestment ratio would have been 120% or above. Back in the days when the industry was able to borrow low-cost debt and go fund their drilling programs. Debt's a lot more expensive these days. Banks just won't lend it, so the industry is self-financing, which it can do since cash flow from operations has been on the rise, and certainly improved from a couple of years ago. So about 60% of those dollars are being spent to drill and complete new wells. 60 to 70% of those dollars are being spent to drill and complete new wells. We think that'll be the case going forward in 2025. So not much of a movement in terms of the reinvestment rate. The rest of the dollars, the dollars that aren't going back to CapEx, for the most part, these oil companies have delevered their balance sheets, so they're not really retiring debt as they would have been doing back in 2021 and 2022. Most of those dollars are now being returned to shareholders in the form of stock buybacks or dividends or whatnot. So the point I would make, though, is we think capital discipline works both ways, right? Oil prices skyrocketed in 2022 and were higher in 2023, and we saw some improvement in plowback, but I think it just sort of returned to its steady state level, and it stayed there even though we've seen oil prices drop this year and natural gas prices fall out of bed. So the capital discipline story kind of works both ways. Oil prices, gas prices, commodity prices move around, but operators, at least for the past couple of years, have appeared to have stayed fairly on track with what they had anticipated to spend. And we think that'll, again, drive or set the stage for activity in 2025. Just a couple of comments. We think about our oilfield service firms and the dynamics that they're facing. So about half the rigs that are working today are employed by operators who are on one side or the other of a merger. And so there's just been a lot of churn in the contracts. We all know that Company A buys Company B, Company A brings its suppliers and displaces the Company B suppliers, and so now those guys have to go find work from somebody else, and so there's been a lot of that kind of churn, more than normal, in the marketplace, and that's weighed a little bit on activity, we think, and I think it's going to continue to weigh on activity because clearly 2024 has seen M&A, while the pace in terms of dollars being spent anyway has slowed, it's spread out. Last year it was almost entirely Permian-centric. This year we're seeing other basins, the Bakken, DJ, and so forth, involved as well, the Uinta basins and so forth. And the size of deals means that is smaller, so that so instead of just the super majors or the shale majors, it's now moving into sort of second-tier firms as well. So that churn activity is just with us. The low asset utilization on the part of many service firms has meant that they just don't have much pricing power. And we can talk about pricing in a little bit more detail in a couple more slides here. And there have been some deals being done, but the gap between ask and bid and ask has been too great. We just haven't seen a lot of deals done. Very few private equity firms are involved anymore in M&A deals. Most of the ones that have been done recently have been between strategics, between oil service firms, one oil service firm buying another, buying divisions of another. So that, I think, is going to be the case here, is these firms look at ways to consolidate markets, remove unused or low-use assets, and try and improve their efficiencies and all the beneficial things that might come about by a merger. So here's our numbers in terms of activity. We look at rig count. This year we'll average just a hair under 600 rigs if we're right in the last 4 weeks of the year. We think next year it's going to average right around 580 rigs. I think 579 is our number. So down about 3% in 2025. Now from where we are today, we're at 582, 583. So we're not seeing much change quarter by quarter, or if you think of it exit to exit. So exit 2024 to exit 2025 looks pretty flat. I mean, we end up exiting next year at somewhere between 575 and 580 rigs. So not a lot of change from where we are today over the course of 2025. But if you look at the average numbers or the aggregate numbers from one year to the next, down about 3% on the drilling side. Frac job side has been pretty much the same story. Numbers are slightly different in terms of frac job count. So for us, our frac job is one well, or one well is one job. So we're down about 14% in terms of job count this year. We think we'll be down another 4% in 2025. But once again, exit to exit from where we are today to the exit of 2025, not much change. Around 2,700 frac jobs per quarter, if we're correct, over this kind of over the next 4 quarters. So some mix. Our Excel spreadsheets that we send out detail our forecast by basin. So we have rigs, we have wells, footage, and so forth, all on a basin level, and by well trajectory. So horizontal wells, directional wells, vertical wells. So you've got, depending upon the market you're interested in, are you serving primarily horizontal wells? Are you or are you just in the Williston? You can kind of find the numbers there that are our estimate of activity this year, next year, and over the next 5 years. So welcome to, well, I know that you know who you are, you data hogs out there, and if you have any questions about any of those regional numbers, feel free to give me a call. So one of the things we think is that in aggregate, well costs will probably fall 2 to 3% over the course of 2025. They're down about 2 to 3% in aggregate over the course of this year. We think that kind of decline rate will be with us in 2025. So while activity will be pretty flat, rig costs we think will decline a little bit, and as they've been doing. Here are as a deck that looks at day rates for rigs, and we go back again to the first quarter of 2021 and plot both the range that we've seen in the marketplace as well as what we estimate to be the average. So the high end of the range is somewhere around $35,000 a day. These at present. These are super spec rigs, or sometimes they're called tier 1 rigs. There's probably about 500 of them in the U.S. fleet at the moment. Back in the latter half of 2022 and the early days of 2023, there was 100% utilization for this kind of rig. And that established rig rates around this $35,000 a day range. Now, since that point, utilization has fallen about 15%. So we would say today that utilization for these tier 1 rigs are somewhere around 85%. But it's not fallen so far as to pressure day rates lower. And I think that's an important point, because in a lot of segments of the oil patch, what we see is that when asset utilization on the part of service companies exceeds about 90%, that now they've got pricing capacity on their hands. When asset utilization falls below 80%, now it's operators who have the whip hand when it comes to talking about unit prices. And somewhere in this 80 to 90% range, prices just sort of don't move around. They may drift a little bit, but there's no strong movement up or down while asset utilization falls in that range. And that's kind of where we see super spec rigs at this point in time. So I think there'll be some pressure on these rigs and operator or drilling contractors to lower rates as the years go by. They have some capacity to do that. That $35,000 a day rate, your average contractor has probably got $19,000, $20,000 worth of direct costs, but that leaves him maybe $15,000 worth of direct margin. Now there's still SG&A, corporate expenses, things like that have to be covered, capital spending and so forth. So. But that, I think, explains why the folks who are at the bottom end of the scale that are letting their rigs out the door for less than $20,000 a day are basically pricing their rigs at cost and they have no margin in that. So they're sadly in the position of needing to keep rigs busy, but they're not earning enough money to refurbish the rigs as needed and stay in business. Once all the cannibalization can be done. So that's just not a sustainable price at that below $20,000 a day level for many drilling contractors. Now, the other thing we look at from a supply standpoint is the frac side of the market. And one of the things that we pay close attention to are the sales by Allison Transmission of their off-highway equipment. So a large part of their sales is for the oil patch, pump trucks, pressure pumping equipment, I should say, writ large. And the frac part of the business is the biggest part of their sales. They have 60% share or so of the transmission business. So they're a good proxy for the capital spending happening on the part of frac service firms. So as you can see, there's a lot of cyclicality in this market. The important point, I think, for the current discussion is the fact that capital spending on pump trucks has fallen off the chart over the last 4 or 5 quarters. And that tells me that there have been spare capacity, so frac service firms have been cannibalizing equipment to the extent they can. This doesn't last forever, and at some point, there just won't be, they will have taken all the parts off of all the units that are parked along the fence line. And now they have to, and so they'll be at a high utilization and we'll be able to sit down with operators and say, no, I need a higher rate for my equipment because I've got everything booked. And at that point, we would begin to expect to see capital spending tracked by a chart like this begin to pick back up again. So, but that tells me, given the kind of the cyclicality we've seen in the past, that probably come 2026 is when the frac side of the business is going to begin to look a lot healthier from an asset utilization standpoint. And so clearly they have been, there's been pressure on rates from the frac service guys for several quarters now, but that doesn't last forever. We think maybe 2025 we'll still see soft prices in the frac sector, but 2026 could be a different one. So it all adds up to what we think will be, slight declines, 2 to 3% on well costs here in the U.S. in 2025. Switching to Canada. Canada, same commodity environment as we have here in the U.S., so lower prices for oil, collapsing gas prices this year, and yet rig count went up 5%. And we think it'll go up another 5%, and it all gets back to the increased pipeline access issue. So as we saw from a couple of charts earlier, Canadian oil production has risen this year and will rise again next year as operators access the new, I think it's a Trans Mountain line that allows oil exports to the West Coast, and then or oil pipeline deliveries to the West Coast, and then exports to points beyond. Next year, 2025, we'll see the start of their LNG exports. So part of our 2025 growth is, 2024 has been mostly oil driven in terms of the increase. We think gas will begin to represent a greater share of the growth in the Canadian market in the coming year. So we are hopeful anyway that will be the case. At the moment, of course, one of the Trump guys in Washington have talked a big story about slapping tariffs on both Canada and Mexico for products they export to the U.S. To pressure them to improve border security, key issue for the incoming administration. And I've been impressed with the rapid response on the part of the Canadians anyway, because the U.S. is a huge part of their exports to the U.S. are a huge part of their economy, not just for oil, but for many, many, many things. And so they don't want to have to see a higher tariff or quotas or anything like that. So I would suspect that the issue is going to be resolved pretty quickly, such that there's no real impact of this threatened higher tariff on the Canadian oil patch in the coming year. So we have a fairly benign view as to the threat that might exist there, simply because we think that we've been impressed by how rapidly the Canadian administration and provincial level and so forth have responded to the news out of Washington. So, and again, most of the growth this year has been in the foothills area, northwest Alberta, northern BC, and we think those will be the growth areas come 2025 as well. International is our other piece that we want to take a look at. So international has been, in aggregate, a disappointment to us. I mean, rig activity will be up about 1% this year, and we think it'll be up about another 1% next year. It has not suffered so much as what has happened in the lower 48 here in the U.S. But nonetheless, we clearly had overestimated what the growth we might see in 2024, and a big part of that story, of course, was the news out of Saudi Arabia back in March when they were going to factor back their capex, which has really shrunk their offshore program, and it began to see delays in terms of capital spending onshore as well. So the programs are still in place. It's just that I think the Saudis are being very cautious as to how fast they commit capital. They're looking at oil markets and being cautious about how fast they commit capital to some of the big capex plans they have there. So that's part of the story. I think the other thing too is around some of the capacity limitations that we see happening offshore. So, but these are the numbers in both land and offshore. So around 900 and whatever it is, 905 rigs this year, 911 rigs next year, 9,500 wells and so forth. Rig count by region has swung around a lot. That's the chart on the right. Basically, we see most regions in the plus or minus 3% category for the coming year. A bit of a growth still in the Middle East and Asia Pacific, but negative numbers across Central and South America, Europe, and Africa as well. So we get into some of the details in just a second there. I'd like to take a look at just both, how we split between onshore and offshore, because again, the onshore numbers have risen slightly in 2024, and we think we'll be up again slightly in 2025. Offshore has fallen a little bit. That's that story out of Saudi Arabia that's contributed to the decline we've seen offshore this year, but we think it'll be up slightly in 2025 if we're correct. The issue there, and for a lot of these offshore markets internationally anyway, are the bottlenecks around the availability of rigs and vessels and subsea equipment, subsea services, things like that. We've seen lead times beginning to expand. Well costs on the international sector in aggregate have risen on the order of 4 to 5% over the course of this year, we estimate. We think they'll continue to rise at that kind of a rate over the next couple of years, probably, given the signals that we get when we look at lead times and bottlenecks and those kind of discussions. So international market, while North America is seeing well costs decline slightly this year and next, that's not the case. It's just the reverse. In fact, internationally, we're seeing well costs climb somewhat. Slightly higher rate, 4 to 5% per year, as best we can tell in the international sector. When we break it down by region, Central and South America, as we said, down about 3% in 2025, and we've got a little over 150 rigs and 2,100 wells drilled. It's kind of interesting to look at the stories on a country-by-country basis. Vaca Muerta is beginning to see some interest in exporting via floating LNG out there. So they've got plenty of gas and would like to sell more of it abroad. And so there have been some proposals here recently about doing that via floating LNG facilities. We'll see if that 2025 will perhaps allow us see more detail about those plans and maybe begin to think about how that translates into rig count in that country. Brazil continues to perk right along. Equinor is one who has great plans to increase their output fivefold in the next 8 years just from Brazil. So you've got a motivated operator in that market. Of course, Guyana has Exxon with I think 4 facilities in place and another 4 that are in various stages of under construction or planned. So that process continues on in that country, and Suriname has seen its first project sanctioned by TotalEnergies this past year for their big Grand Morgu project. So we'll see more from that country as time unfolds. But they're moving past the exploration and appraisal stage in Suriname to the development phase now. So off we go. Europe down about 2% in 2025. And big news there, of course, is the fact that Labour won the election back in July and has finally come out with concrete proposals around its budget, which talk about extending their windfall profits tax, raising the windfall profits tax, extending its duration for another year, I think, in the grand scheme of things, taking some of the other tax credits off the table, and basically lending credence to the expectation that any project that had not already been sanctioned may not see sanction going forward. So work that's in progress is expected to continue to proceed, but stuff that was being considered, the front-end engineering was being done, but it hadn't reached the project sanction stage. I think those projects are highly questionable at this stage based on what we understand the fiscal regime for the UK to be going forward. And to that end, not surprising, I guess, that Shell and Equinor just a couple days ago now announced that they were going to combine their UK offshore operations. It'll be the largest producer in the UK, 140,000 barrels a day, barrels of oil equivalent a day, I should say. The expectation is that this is being done in anticipation of spinning that off to some third party, maybe a year or two from now. So I think those kind of actions are probably more of that kind of stuff is in store for the UK over the next year or two. So not much new, a gentle slope downward in terms of activity in the UKCS. Norway hanging in there. But the expectation is there again, while the fiscal regime is supportive, the break-even prices are good, all that kind of stuff, the reservoir base is in fine shape. They just have a lot of capacity that could stand consolidation both among operators as well as offshore drilling contractors. So we may see some news to that end out of Norway in the next year. And finally, Africa down about 1%, not much change. A couple of different projects that are just from a timing standpoint begin to affect when we see rigs go to work or come off contract. So fairly steady state as time goes by, but it will be interesting to watch both Senegal and Namibia, because those are the two areas that have seen most of the interest from an exploration standpoint. I think something like 65% or 70% of Africa's rigs are employed along North Africa, but the big exploration plays that are being identified are down in the southern part of the continent. And then finally, we take a look at the Mideast and Asia Pacific. Mideast, we still think will be up about 3% this year. While Saudi may not be lifting its oil export or oil production capacity, it's certainly making moves to expand its gas production capacity. So it's the big Jafurah field is beginning to make moves there, and we'll see much more drilling begin to take place in that area come 2025 and going forward, because they have high hopes on getting that done. The more gas they can produce, that allows them to export more oil, because they can substitute gas in their power plants and take the oil that's being burned and generate power and export that now. So it's a win-win, as it were, for Saudi without having to explicitly raise their oil production capacity. They increase their oil export capacity that way. Abu Dhabi's got gas production capacity expansion underway. Iraq's got BP involved there, and so we think the area will be active and slightly up come 2025. Asia Pacific then, last area we'd look at in detail, again, fairly steady state, maybe a little bit up as the year unfolds. got some interesting things happening onshore in Australia. Their shale projects in Perth and Beetaloo are beginning to really make some interesting moves in terms of discoveries and production levels. India is, of course, the most active operator from a driller from a number of rigs running standpoint, and so it doesn't change much year to year, but again, it's staying fairly steady come 2025. Indonesia and Malaysia also have big projects that are underway and getting close to sanction or have just been sanctioned, and so again, a lot to expect that we might see activity in the Asia Pacific market begin to perk up a little bit as next year goes by. So with that, I have come to the end of my prepared remarks and am willing to answer any and all questions. I do want to mention one thing about the impact of the new administration. Perhaps illustrative that today is the anniversary of Washington formally opened.
The obelisk?
1884, the obelisk, 550 feet high. It opened in 1884 at the end of a 36. So change does not come fast, Washington, I should say, and we might keep that in mind when we think about a new administration over the course of life. But with that, you've written something down.
Yeah, so we've got some questions that have come in from a variety of ways. People can put them on the YouTube thing. They can send them via LinkedIn. They can email us. They can call us. They could mail it. But that would be get here before Christmas or so. So one of the questions was if U.S. Completion activity, but specifically in the form of hydraulic fracturing. Yes. If U.S. hydraulic fracturing activity begins to rise, at what point do we begin to run into an equipment shortage? The observation being that we're in a 3-year run, probably going into the 4th year, where in terms of revenue generated from hydraulic fracturing, it's been very flat. Yeah. And you showed the chart with Allison Transmission where it's like we're not spending any money building. And so if you see activity rise, where do you run out of capacity and then create a squeeze?
Yeah, good point. First thing I want to say is here in November, December, I think we're seeing caution frac activity.
No question.
That has happened now for 2 or 3 years. Rig count has stayed fairly high. Crew it's down. I think probably January we'll see some recovery, but I don't think we should anticipate that. I think it's just sort of a recovery with fresh money in the budget.
Let's extend January, February, March for 20 years.
Yeah, so good point. If was there a number? If frac activity went up 20%, roughly where it was start of 2020.
Yeah, but get this in terms of dollars.
Right.
It's not all that different. On a global basis. But in the U.S., yes, spending on hydraulic fracturing work is down about that much, 10 to 20% from the peak.
Yeah. So I think at this point the industry would have a great deal. It could probably handle a 10%.
I agree.
20%. I think normally high utilization. Two things. The job they're going to. Secondly, pay for the new.
Step number one is going to be trucks go back to work at today's rates. Yeah. But 6 months later, there's going to be a material increase in what you got to pay for a frac crew. Yeah. And
so, do you think that comes in the form of a higher rate for their, or in the fact that frac service sand to locate at and margin the sand to locate?
You saw a whole bunch of sand migrate back onto the job ticket of the frac service company. Maybe a little bit's migrating away from it right now, but I think that we are in a long-term process of returning the sand back to the frac service company and the chemistry. Again, not every job, not everywhere, but it's a trend.
Do you think that's because frac service increase, or that's really a general contractor.
You know, look, so
Yeah.
EOG, for example,
Yeah.
is fully organized in a way to run those separate business units and be a sand mine company.
It is.
So way to go.
Absolutely.
But normal
job,
mortals
Paul.
can't do that. it's like particularly a sand mine.
You're absolutely right. I mean, there's scale issues, right?
Oh,
So
yeah.
some operators are bigger than others. Small guys.
Well, yeah, and how about this? What if my sand mine that I own as an
Yeah.
oil company,
Yeah.
you know, it's in this county. Let's
Right.
pick Howard County out in West Texas. What if the new play I've got is 100 miles away from there, and I've got this one sand mine? It's mine. I go, that's too far away.
That is a fact. One of the things you'll see in our numbers is that we see a shift. You know, I think this year was the first time that the Delaware subbasin, far West Texas and New Mexico, the number of wells exceeded the number of wells being drilled in the Midland subbasin. And
Well,
so
there you
you're
go.
absolutely right. And that going forward, I think will just continue. So you're right. Guys who were set up for Midland subbasin operations are going to be like, boy, that's a long ways now. And so
it's this like sand mines and Ubers. It's kind of the same
and,
idea.
and it's sort of like you got to get to the right scale in now the Delaware. You know, maybe I'm big here, but maybe I'm still small there. So here frac service company, you got it. What's else?
All right, next question, which is if I got this one yesterday in Houston.
Okay.
If peace breaks out around the world, because again, Mr. Trump, he's got a track record of causing people to like, I'm not going to attack because I don't know what Mr. Trump is going to do. So if peace breaks out around the world, what happens to this forecast? Your peacetime
my peacetime forecast. Yeah. So so question number one, the answer to that is there a risk premium or a war premium in the price of oil today? And I say the answer is no.
That's right. We've had a crazy set of wars going on right now. They're bombing Israel and they're attacking. The Russians are attacking.
And we can't. I mean, we're having a tough time sending stuff through the Red Sea. I mean, the Suez Canal. I mean, there's just a bunch of stuff.
Price of
going
oil
on,
is $70 a barrel. Yeah, almost.
So So peace in and of itself, hasn't. We didn't see a premium when the Israelis went. After the Iranian stuff, that was going to be the end of that. So I have a hard time imagining that that the price of oil changes very much. Certainly,
because you would say that it actually already reflects a peacetime premium, despite these.
Well, maybe not a peacetime premium. I think it just reflects economics.
I don't want to be where the bombs are falling. That doesn't feel like peacetime, but.
Now, would it shift activity? Might there be activity in some places that are in hostile territory today? Right.
Oh.
So, I mean, if you did that kind of a thing, then you might say, okay, well, there are places, Sudan being one, parts of Iraq being another that might see it. But then you have government competence issues that might come out. Here's a question for you. Let's say peace breaks out. Do we start drilling in California again? Right.
Well, you're back to government competence. Like that's a hostile environment, right there.
If I say that what's the chance of peace breaking out is zero? What's the chance of drilling in California again? Less than zero.
It's like a negative.
It's a good question, but I just don't see much of a risk to oil prices for that happening.
So for many of the people who are our clients, they're looking at our point of view with respect to drilling wells, completing wells, and producing wells.
Yeah.
They don't really look to us with regard to the transportation of the oil or the gas, so pipelines and things like that, right?
Right. Yeah.
So I saw somebody the other day say, "Hey, now that you've got Trump back in, the Keystone XL pipeline's back on the list." And my answer is, having been on the board of directors of a company that was building the Keystone XL pipeline, that a 4-year presidency is not long enough for all of that risk to go away.
Oh yeah.
Because you got to redo everything. You got to buy the steel pipe. You have to resecure all the leases.
More importantly, no one wants to build the pipeline anymore.
Why bother?
Right. They built a pipeline. The Canadians built a pipeline. I mean, they wanted to build XL because they needed our export capacity. Well, they in the meantime have their own, developed their own. So.
And you can still send it over by train anyway. To the south.
So that is one of the things, though, that a new administration might do is with regard to the infrastructure story there. So we talk to operators, and we just don't see many of them thinking that change of the team in Washington is going to do much in terms of activity, rig count, things like that in the coming year. Now, longer term, removing this pause on LNG export terminals is probably a good thing. But like I said, there's issues in the LNG market itself that no one president's going to solve, right?
Somebody has to want to buy the LNG.
Somebody has to buy, right? Absolutely.
Right.
Now, you might get a few more pipelines out of out of Marcellus. That could be an important. There could be some things that might move needles in specific markets. Marcellus is kind of the first one that comes to my mind that might happen, and so that might have a very regional impact, but just blanket stuff, no. I don't.
So my two favorite sub basins right now, the emerging sub basins. Let's see if you agree or not. Up in the Marcellus Utica, you've now seen an oil play develop. I think it's in the Utica side. I don't remember which one. But it's like, we're finding big oil wells. Why not, right? It's just, but anyway, there's an emerging oil market. And can you export the oil? And and the other one is this really remarkable positive response for horizontal drilling in the Uinta Basin, the Utah part of the Uinta Basin.
Northeast Utah,
And a shout out to Will Spears, who's up there living. So we already got a guy on location
freezing
up there.
his butt off.
That's right. I'm freezing my butt off here.
The Uinta thing is an interesting story because that's sort of the first new basin in probably
a long
10 years' time here in the U.S., right? I mean, we've been talking about the same plays for a long time, and we just haven't added to that list. In the early days of the shale market, we were, it was Barnett and Fayetteville, and we were, each year there seemed to be a new one, and we just haven't been there. So that's kind of interesting in and of itself. One thing I do want to, back on the issue of Trump. The fact of the matter is that I don't see interest costs going down very much, right? Inflation might fall, right? He's going to work on inflation. And maybe interest rates come down a touch.
Okay.
But, some of the plans that have been put forth that would expand the deficit or certainly not shrink the deficit very much suggests to me that interest rates are going to stay high. And if interest rates stay high, it's going to be, it's not like the oil patch is going to go out and borrow and have availability of a bunch of cheap dollars to go drill with, right?
Oh.
So we're not back in that 2010, 2018 environment where interest rates were rock bottom and the industry, got happy. And so I don't see, a new Washington crowd affecting interest rates very much. And if that's the case, then I think the posture of operators in terms of capital spending and capital availability kind of stays where it is.
Because you have to have the two things. You have to have the capital that wants to come into the industry, and you have to have the industry that wants the capital. It's two pieces of that pie. And currently, the capital providers go, "I'll give you a little bit."
Maybe,
but do not grow.
Right.
I'll loan it to you. You have to give it back. And the operator's going,
I'm only speaking. So I think that's a very important thing because I think that affects, dollars in, is a key to what we're talking about here.
Okay, so we have two more minutes ish. One was this: offshore drilling has been rising slowly.
Yes.
And the revenues associated with offshore drilling have been rising slowly now for, I think, 3 years, maybe 4 years. But next year's going to be up as well. And the capacity of the industry itself to put another rig out there is kind of bumping up against capacity.
Yes.
I've got a bunch of old drilling rigs out there, but I don't want to drill those kind of holes in water anymore. So the rigs that they want so it's been rising. Is there a point at which that tops out?
At where rig activity?
Think of it as not just, it's the combination of rig activity, the cost per day to the operator of that rig, and or does it just have this slow 10% per year increase? And I can look at it and this is partly a question for me because I have a pretty significant investment in a public offshore contract driller.
Well, past performance is no. So it's a good point. I don't know that all trees grow to the sky, right? So I do think we're getting close to 100% utilization for deep water floaters, things like that.
Yep.
And so their rates have risen, and will grow. But there comes a time when if oil prices aren't moving, then I think activity levels flatten out. They may flatten out at 100%. utilization, but I don't know it's enough to like put more, start building more rigs. There's been some units that have been, or are being finalized and, will be coming in, but not very many. So jackups are a little bit different story, but different only in the sense that they haven't got as far as the deep water stuff yet. That's where the primary emphasis has been. So, so there's a couple years where rates and utilization might creep up a little bit more from where it is, and rates will go up certainly. But I don't know that you can just sort of,
I can't just
it all the way
extend the
through,
line
right?
for 20 years.
Sadly, no. Sadly, no. And I think the issue is around that is that we're a 1% growth in terms of global oil demand kind of a thing, and I think operators are going to be cautious. Probably spend more. At some point, they're going to want to, and you see this in the announcement of the big diversified service firms, Baker, Schlumberger, and so forth. That we see more money being spent on mature fields than on new fields. And
so to that question, one of the questions we've just gotten is,
look at this.
Do you think that operators are going to focus on drilling new wells or on recompleting wells? And where are drilled but uncompleted wells in that mix?
Yeah,
and
right.
I'm going to answer the second part of the question, which is
you got it.
I don't really think that there's anything other than a normal supply of drilled uncompleted wells at this point.
Yeah.
I don't think they're building. I don't think they're shrinking. I think folks drill their wells and then complete their wells in the U.S. market.
It's not 2018 where we got surprised by prices and
that's right.
we just stopped.
So that's my position about that.
I think that's fair.
It's about yours.
I think that's fair. I think the recompleting thing is, refrac, whatever you want to call it, is it's the perennial, new girl at the party. But I just don't see much being done. I think some operators who've talked about it in the past have said we might have a little bit oversold what might be the economics, as it were, of refracking, because again, you think about it. The candidate wells are ones that were fracked more than 5 years ago, where the spacing was 500 feet between frack stages. Now you come back in, we're doing it 150, 200 foot frack spaces. So there's some capacity, but we still don't know where the frack went when we did it with the larger spacing. So the number of candidate wells is, it's hard to know like what you got and how fast you want to try and exploit an older mature well by refracking it.
So, I spent a couple 3 days in Nashville, Tennessee, just about a month ago with I'm going to think of it as partly a recompletions symposium that the SBE put on. And in talking to some actual recompletion specialists there, it sounded like if you recomplete something, refract something, it's actually the parent well and not the child wells you develop from there. And in my simplistic mind, it's to repressurize or restore the parent well back to its original state. But also, look, I am not a reservoir engineer. I was a rock mechanics guy at best. If you got stage 1 here and stage 2 here, and there's 300 feet between them, I guarantee that 250 of those feet are virgin rock at virgin pressure. So what do you do to go back and get that? But there's some great consortium work going on. NSI is leading this issue about the perforation and access issue. There, and I'm pretty excited about it.
So we've got a ways to climb up the learning curve.
Yes, we will never be done with the learning curve.
So we'll see how that goes. So.
Johnny, we are at the end. I just want to let people know that next week I'm in Denmark and London. Come by and see me. I'm working, not goofing off. Although those sound like places you would goof off. And then in I think it's the first week of January, the first full week of January, I'll be in Midland, Texas, with a drilling forum. It's 500 people at the George Bush Convention Center there, and I love this event. And so you'll
look
figure
to
out
see you there. Come up and shake your hand.
I'll be in Dubai in February. It feels like goofing off, but it'll actually be working. I don't, and I'll be with you on Christmas.
Fair enough. Well, thank you very much for listening today. If you have any questions, we will be updating this forecast in 3 months' time. In between now and then, if there are any questions on any topic, please reach out. Always happy to have a chat and answer any questions we can. Thank you very much. We'll talk to you later.